what are the highlights of the quarter? If you could start by telling that to our viewers.
Yeah, so thank you for inviting me in the show. And I must admit that last year was challenging. And I would say that second wave only increased the challenges. Despite that, we have demonstrated resilient financial performance and continue to remain focused on achieving our operating and financial targets. During the year as well as the last quarter, we collected 99% of our lease rentals, and with less than 1% being delayed or waived off due to rent loss for amenity areas where we have a revenue sharing arrangement. Our operating lease rentals have gone up by have gone up to rupees 6.1 billion vis-a-vis rupees 5.9 billion, and which is a cost increase of about 2.5% in FY20, and that was driven largely by contractual escalations. Our comparable NOI stayed constant at rupees 6.5 billion year over year, and we have 91% same store occupancy at the end of March 21, which indicates the robustness of our portfolio. We have also done about 7 lakh square feet of leasing and completed about 5 lakh square feet of new development. Considering the challenging year and the fact that as soon as things have started looking better, we all were hit by second wave, I think we have done remarkably well and we are satisfied with our performance.
So what is the impact of the lockdown on the overall industry?
Sure. In Q1 2021, we have seen many of the tenants coming back to offices, and offices were gradually opening up. And we were talking to new and existing tenants for new space take up. And some of the tenants were talking and discussing with us for consolidating their portfolio in our campuses. And we all felt that leasing momentum is back and will gradually pick up. However, the second wave was sudden and unexpected in its intensity, and the leasing momentum has been pushed back. Today, the priority is health and safety of employees, and something that's natural, and we understand that, and that has to take a precedence over anything else. However, we do not expect the demand to go away, but it has got delayed by about 4 to 6 months, or maybe 4 to 7 months, and we are very confident it's going to come back. However, what second wave has done is that it has hastened the urgency of vaccination and removed any hesitancy in what people minds was towards vaccination, and also has spurred the government to ensure that enough vaccines would be available, whether it's through imports, it's to tie up or increase production of vaccine. In fact, we ourselves as Brookfield Properties are organizing vaccination camps and vaccination drives all across our campuses on a pan-India basis for our tenants, partners, and vendors. And we have seen that companies like US, where vaccination has progressed substantially, companies are opening their offices and are coming back. And we expect the same thing to happen in India going forward in the next 4 to 6 months. It should pan out.
Okay. Hi, Mr. Aggarwal. This is Mubina as well joining in. What is the outlook for FY22 for the office space? Because this is something that's been so dynamic since April 2020. How are you looking at that? What's the work from home impact on the entire office space industry?
No, I think fair point. I think any discussion on commercial leasing today cannot be done unless we talk about work from home. So see, work from home was need of an hour during the pandemic, and it has served its purpose well. And definitely work from home has definitely become more acceptable since last year. However, let's be honest, we have seen companies spend great number of resources and time in building culture, innovation, and for the growth of the organization. And the same cannot be done by working from home. So we are very confident there is no substitute for office working. Work from home can aid the office working, it cannot substitute the office working. And some of the other trends which are favoring our business and which are going to pan out in long term, we can see increased digitization, increased hiring by IT companies, and they're swilling order books. And bulk of our tenants are large multinational and domestic IT companies. We also see shift of tenants from grade B developers and non-institutional owners to institutional owners and grade A developers, and we are going to benefit and take larger share of market going forward. And we also see substantially shift of tenants from standalone building to campuses. They have options for growth, open spaces, and host of amenities. And in our portfolio, all of the assets are campuses, and we expect to benefit by that. And we are also seeing de-densification. What does it mean is that average space per employee is likely to increase in the future as companies look to ensure adequate physical distancing norms. And also what is happening is that because of crisis, office supply is likely to be constrained in short to medium term, because developers are not starting new development, and also that under construction projects have been stalled or delayed in many of the cases due to limited supply of labor and capital. So the outlook for commercial real estate is robust in medium to long term.
Okay, Mr. Aggarwal, how have collections been impacted, across the industry? What's the, the size of the impact, if you could quantify it? And what is the impact of client renegotiations, when you sit across the table, given how things have shaped up? You spoke about how the office space bit has as well shaped up on account of work from home. How many clients, have you seen want to renegotiate the terms and agreements with you?
See, collections, we have already talked about that our portfolio has seen 99% plus collections of these rentals, and we are confident that same is going to remain going forward as well. How in some of the cases, in some of the industries, and I would not name the industries, but which were badly hit by COVID, there we have seen some downsize and impact is more, but we do not have those kind of tenants in our portfolio. We had a small portion of tenants who were affected by COVID, but today those tenants also are paying rent and they are current on their payouts. When we talk about renegotiations, see, the average rental in a portfolio is substantially lower than the market rentals, and this ensures that downside is protected and we are not subjected to renegotiations. Some vacancy, is always there, which comes in any point of time. And since our rentals are substantially lower, if a vacancy comes up, it's going to get leased at higher rentals. Of course, it can take some time, but that could be accretive to portfolio. So that's our view. And also, we have been able to get 9% of our contractual escalations on 40% of the lease area. So that shows that, the rentals are moving up. Our tenants have largely retained space. And the fact is that our same store occupancy is 91%. It establishes that. Our tenant retention rate is about 79%, and any portfolio about 10 to 15% yearly churn is there. We have marquee MNCs tenant who run business critical operations from our campuses. They have robust cash flows and are growing, and they largely retain space, and occupancy is robust.
Sir, do you think will REITs rethink their dividend strategy? Will there be more need for fundraising due to the lockdowns?
Yeah, many questions. Let me take one by one. See, investors invest in REITs to get a good dividend yield and good distribution. So that's something we are very mindful about. And all REITs, including our REITs, will ensure that their cash flows are distributed as per the policies. And our endeavor would always be to distribute the dividend which they've been projecting, or better than that. In fact, our REIT has also given a visibility of distribution of about 12.75 rupees for next 2 quarters. For both quarters, we plan to distribute about 12.75 rupees. That's a visibility we have. So the policy would be to kind of increase dividend, whenever possible, or stick to the policy. In terms of growth, we're always looking for opportunities, but we have conservative capital structure, and our gross debt is just 18% to the value. Regulations permit us, we can go to the extent of 50%. So we have sufficient headroom to raise capital in case opportunity is there, and of course, if opportunity is there, we would like to explore that. Having said that, any growth has to be value accretive for investors, then it's meaningful.
Right, sir. Thank you so much, sir, for taking out time for us.